Most people ignore trading Asia session because they think that there's no volatility and no clean setups. But the truth is, Asia session can be one of the most consistent sessions as long as you understand how to read liquidity. In this video, I'm going to be breaking down exactly how I trade gold during Asia session almost every single day using only liquidity and identifying the right dealing range. Something even a complete beginner can understand. This is the same exact framework that I teach every single one of my students when they first start out to become consistently profitable. No indicators, no fancy tools, simply a framework that is centered around understanding liquidity and finding high probability setups. By the end of this video, you will know exactly how to mark out the Asian range. You will also know exactly where the liquidity is building up. And lastly, you will understand how to position yourself for continuations in London session and in New York session. So go ahead and grab your charts. I'll break this down step by step on gold, and I'll show you how I structure my bias, my dealing range, and time my entries on Asia. Okay, so here I have the gold futures chart pulled up. There's a few things that I want you to have on your dashboard. Now, mind you, I do not trade NASDAQ during Asia. I don't care if there's a setup. I will not trade it simply because I would rather wait for New York when trading NASDAQ because the volatility is drastically increased. So we're going to be primarily focusing on gold setups during Asia. There's a few things that I want you to have on your chart. I want you to have either gold futures, the mini chart, or you can have the micros chart, which is the same. For now, during the current contract rollover, we are in the Z period. We are in the December expiry contract. So we want to have GCZ 2025 loaded up on our charts. And then if you want to trade micros, if your account size is a little bit smaller, you can't trade micros. It'll be MGCZ 2025. So there's a few correlated assets that I will use when trading gold. The first is going to be DXY, which is the US dollar index. Now, I do use the DXY when it comes to inverse SMT. So the DXY is going to be inversely correlated. The US dollar is going to be inversely correlated to gold. So I will use that. Now, the Euro USD. This isn't something that you'll typically see most people do, but I know that the Euro USD is indirectly correlated to the DXY. And because gold is also indirectly correlated to DXY, that means that in theory, Euro USD and gold should be directly correlated to each other. So I would also use that for SMT. Now, I'm not using it on a structural basis, highs and lows, waiting for them to get taken out like you would use on NQ and ES. But I am using it kind of for like an overall daily bias type of SMT. Okay, so now that you have your gold chart pulled up, the first thing is to understand exactly where we are. Now, I do use an indicator here. It is called Market Profile at Josh Shu. Now, what this indicator does, I used to do a lot of this manually where I will manually annotate the different sessions, the different separations of the day, but this indicator just makes it a lot easier. Again, I don't use any other indicators other than this, which does, if you go down to like the 15-minute time frame and below, it will indicate a few different things. This orange line will represent New York midnight opening price, which is extremely important to have on your chart. It also lays out the London open kill zone, New York AM, and then New York PM as well. And then this box right here, this like pink orange box, is represented for Asia. So the market does open at 6 o'clock p.m. So between 5 o'clock p.m. Eastern Standard Time and 6 o'clock p.m. Eastern Standard Time, the market is actually closed. And then it does open back up at 6 o'clock p.m. Now, sometimes there are setups that form directly at 6 o'clock p.m. However, I prefer to wait around 8 o'clock simply because there is more of an injection of volatility around 8 o'clock. That is officially when Asia session starts. And then Asia session will end at around 12 o'clock a.m. So between 8 o'clock p.m. Eastern Standard Time and then 12 o'clock a.m. Eastern Standard Time, that is when you want to be looking for your setups on gold for Asia session. So considering that we are at all-time highs, it is kind of difficult to navigate shorts. So I wouldn't really recommend shorting unless the opportunity is presented. I mean, pretty much we are looking for higher prices on gold overall. If you do go over to like the monthly or even the weekly, you can see that gold has just been ripping up higher, and it's going to continue to rip. It's going to continue to rip for the next, couple of years. I definitely see gold hitting $6,000, $7,000, $8,000, but that's besides the point. So how do you trade gold during Asia session? So primarily, Asia session will be a continuation of whatever happened during New York PM session. There is something called time distortion where the candles still have to print, but because there's no injection of volatility, the market won't move. So time still has to pass by, so candles will always be printed. But sometimes you'll notice that if during Asia session and London session on a specific day, if we expand an aggressive amount or we move a lot, New York will chop the entire session. So that means that going into Asia session the next day, we will expand again. So that is when the moves will be offered. So I'll pull up some examples right now. Before I pull up some examples, I do need you guys to understand a simple concept, and it's referred to as the dealing range. Now, the dealing range is extremely important to identify premium and discount. And I will be creating a separate video specifically talking on dealing ranges, but just for briefness sake on this specific video, I need to mark out a few dealing ranges. So I'm gonna pick a random day. I'm actually going to choose this day right here because I did trade Wednesday on this day, and I did trade actually Thursday on this day, but I'm actually going to mark out a few different things. So as of right now on this current day, and I'm actually going to chop price right here. Okay, so on this specific day, we need to identify the dealing range. So if I were to actually take this tool out right here and we just look at overall market structure. This is overall market structure on the higher time frame. I know there are more highs and lows within, but overall, this is the market structure. So based off of this trend lines that I kind of just drew out right here, we can tell that right as this high right here was broken, we had a market structure break to the upside. Okay, that means that this was a key high that we took out, which means that price would then return back into that high and then continue up higher. That is like basic candlestick market structure, okay? Very, very basic. Okay, so we first need to identify the current dealing range that we are trading within on October 14th. So I'm gonna actually be marking out my dealing range from the high to the low, and this is extremely important, marking it out from the high to the low, not the low to the high. So because we're marking it out from the high to the low, whenever price pushes up above the 50%, I'm not expecting to sell because I want to see this high taken, assuming that we're maintaining bullish order flow and bullish market structure. We're simply measuring this range to identify, okay, when price pushes above here, we would simply be looking for price to come back down and then push back up. So this is the current dealing range that we have yet to break. Now we can kind of, within this overall range, there are going to be smaller ranges that reside within. So let's go ahead and mark those out as well. We can see that we have this internal dealing range right here that we would mark out from the low all the way up to this high right here. In this instance right here, if we're currently above the 50%, that is when we would be looking to short into the discount. Okay, so you can see here, price then comes down into the discount of the range, into optimal trade entry. I don't currently have them labeled out right now, but I do know that anything beneath the 50% of the range is going to be considered discount. We trade into this order block, and then you can see that price goes from sweeping internal range liquidity to now taking out external range liquidity of this internal dealing range in the overall range that we are trading within. And then right as price breaks and closes above here, we then create a new range from this low to this high, and then every time that old high gets broken and closed through, a new range gets created. Okay, so how can we use this to frame setups for this given day on Asia? I know that this right here is my overall draw on liquidity. This is my overall draw, okay? I'm expecting price to push up above here. This low right here becomes our protected low. The reason why this is our protected low is simply because it's swept liquidity and it is responsible for breaking structure above this old high right here. With that in mind, as long as we don't violate this low, I am still bullish in targeting this buy side liquidity that is resting above this old high right here. Okay, so we're gonna kind of zoom in right here. So right at 6 o'clock, okay, 1800 open, we pushed up aggressively and we displaced through this down close candle right here. Right as we displaced through this down close candle right here, we had an official change in the state of delivery. Now, what this represents is that price is now going to be seeking buy side. This now becomes our new protected low. Now, why is this our protected low? We swept internal range liquidity here, and we pushed above this old high and we broke above it. So this low is responsible for not only sweeping liquidity, but also giving us a market structure break. So right at 6 o'clock, I was watching price here during this 6 o'clock open. We displaced aggressively. Now, while most traders will have FOMO and start entering based off of that aggressive move, I simply sat on my hands. I wanted to wait for more data to come out on the charts, for more candles to be printed so that I can confirm that we are actually going to push up higher. So this is exactly what I did. I noticed that we actually came down here and we rebalanced this inefficiency right here. Now, unfortunately, I did not get in right here. I missed this. And if I were to get in right here off of the 15-minute chart, my stop loss would have been way too large. I don't want to have a stop loss of 100 ticks on gold. Typically, my stop loss will be maximum 50 ticks, maybe 60 at most, but anything under 50 ticks or 5 points is ideal for me on gold. And then I'll typically target a minimum of 10 points, 100 ticks or so. In this instance right here, this would have offered 232 ticks if you took the setup. But again, this was too large of a stop loss. So I waited, okay? I wanted to see a smaller range get created. So right as we pushed up above here, we had another change in the state of delivery. Again, I mentioned earlier that I prefer to wait until 8 o'clock p.m. anyways, because there is more of an injection of volatility that does come into the market. So right here, as we had another change in the state of delivery, we had another market structure break above here. Once we close above this high, the new dealing range that I'm going to be marking out is from this low to this high now. So essentially what I'm going to be doing is I'm going to be waiting for price to come down into the discount. Now, if I go back and drop down into my 5-minute, we can actually kind of see it a little bit clearer. Now, ideally what I want to do is I want to find any PD array or any area of liquidity that is beneath the 50% of the range that I can use to target for my internal range draw. Once that internal range draw is met, that is when I will now start looking for entries. So right here, this is the lowest low right here that is within this area right here. So I waited until price pushed down beneath this low. Now I could have taken a setup here, but again, I was looking for buys, so I did not entertain any shorts. Once price comes down into here, you can see that there is a fair value gap paired with an order block. Whenever you see a fair value gap paired with an order block, that is a double confirmation. That is golden, especially if we're sweeping an internal range low or an internal range liquidity that is also paired within this. That is a triple confirmation. That is telling me that we are likely going to reverse from this area. On top of that, a fourth confirmation that we have is that this candle that swept that liquidity failed to close beneath that low. Once I saw us fail to close beneath that low, that is when I dropped down into my 1-minute time frame. When I dropped down into my 1-minute time frame, that is when I said, okay, I want to find an entry. So let's just say, assuming I got in here, which I believe I did get in here, I originally had my stop loss beneath this fair value gap because there's no need for price to come down any lower. I really don't even want to see the bottom of this wick violated. But because we have a new candle opening on the 15-minute time frame, there is a possibility that we can do something called a double sweep, where we will sweep this candle's low. So to have a safe stop loss, I will keep my stop loss there. So let's just say I got in right here. My stop loss goes down here. My stop loss here is 35 ticks, which is perfect within the range that I want it to be. And then what I'm going to be doing is actually targeting all the way up here. Now, the safest target, if you are a complete beginner, is going to be to target the 50% of the opposing end of the range. And again, you're going to be marking it out from the high down to that low. So this would be the safest exit. Now, if you want to be a little bit more aggressive, you could also target the first PD array in the premium, which would be this fair value gap right here. That would be that first target that you would have. But for me, I do want to target the external range liquidity. So that is what I was targeting. So assuming that I entered here, let's go ahead and play it out. Okay, perfect. So far, so good. Okay, boom, we have this displacement upwards. That is when I'll now show my stop loss. Now, a lot of times what I'll do is once I see some sort of displacement, I'll actually add in a contract. Because I am in replay mode, it's kind of difficult to do that. But assuming that we had this displacement right here, I would have probably added in another contract here, keeping my risk at an overall of like $400 total. And then I'm simply just going to leave my stop loss here until we do end up displacing through a few opposing PD arrays. Ideally, I don't really want to trail to break even until we push above the 50% of that opposing range. So let's just let price do its thing. Okay, now that we fully displaced here, I'm actually going to move my stop loss beneath this down close candle, a little bit above break even to secure some profits. There's really no need for me to let price come all the way back down and stop me out. Whenever we are in bullish order flow, I always expect down close candles to support price. So this is the lowest down close candle in this entire run up. So again, I am expecting this to hold up as a area of support. Now, because we have hit this fair value gap and we have yet to reach this fair value gap in the premium, I understand that it could be some sort of retracement. Price could come down, tap this order block, and then push us up, which is actually what happens. You'll see in a second. That is exactly what happens. Whenever we have a swing high that has an order block and a fair value gap in it that has yet to be retested, price will always offer a reaction. Now, the reaction isn't going to take us all the way down to this low, but it is going to offer us a reaction into the discount of this new range from the low to the high. Okay, so we could have a possibility to come all the way back down here. So let's see what happens. Boom. Okay, assuming that, this is the new high right here, you can see that price actually does come down into the discount of that new range. Once that new high got created, again, this wasn't a swing high, I just marked out this high. So once that new swing high got created, we now mark out the new range from this low to this high, and we can expect a retracement simply because this order block right here, all of these consecutive up close candles are now represented as an order block once we had a change in the state of delivery. So that means that once price broke through and closed through these consecutive up close candles, this becomes an order block. Because this order block has not been retested, we always have to expect a reaction off of it. So that means that price will not seek external range liquidity until we get that reaction. But the reaction until when? It's typically going to come back down into the discount of that range on the buy side of the curve. That's totally normal. You were up a lot of money. Again, that's why I said the safest exit is either going to be at the 50% or it is going to be in the premium of the range. Now, one tip that I could give you is that if you are trading with multiple contracts, maybe you have multiple minis or multiple micros, you could take partials here, here, and then try to hold all the way up to here. And then once price does retrace all the way back down close to your entry and close to your trailing stop loss, you can then add in more entries. That is something that you could theoretically do if you did have more than one contract. But again, I am targeting these overall highs. So again, we're going to wait for price. Boom, you can see price ultimately hits our target. And that is a beautiful trade that you would have caught during Asia session. Now, a lot of times, depending on the overall narrative on the higher time frame, price will continue to run beyond your first target in Asia, and you can actually hold your trade during London. Now, personally, I don't like to hold my trades overnight. I don't like to monitor. I do not like to be in any positions while I am sleeping, simply because I do like to trail according to my trades and watch and see what happens. So that is not something that I would have done. I would have gone out right here and then called it for the day. Okay, so moving into the next day, October 16th, let's go ahead and frame out our market structure so that we can identify our dealing range. Okay, so I've just outlined all of the market structure. So our current dealing range that we are stuck within going into Asia is going to be from this low all the way up to this high. Okay, so now that we have our current dealing range marked out, we can now start framing our setups. You can see that price opened up here at 1800 opening price, 6 o'clock p.m., and we made a push up. Now, we did come back down and retest this fair value gap, and then we did make another push up. But I want you guys to notice what happened here. Right as price was approaching this high, we had something called a failure swing high. Not only did price fail to take out that liquidity, but we also failed to close above. So that means that we are likely going to reverse and come back down. Now, that doesn't mean that we're going to reverse and shoot all the way down and now we're all of a sudden bearish, but that means that we need to retrace relative to this range that we've outlined from this low to this high. The 50% of the range is right here. That means that we need to find any PD array underneath the 50% of the range that we can use as a target. Now, in this scenario here, because the range is so large, from this low to this high, the range is 116 points. That's 1,163 ticks. With one contract, one mini contract, you would make $11,000. It's a huge range. I would actually be looking for shorts here. Unfortunately, on this day, I did miss the shorts. I did participate in the longs though. So how could you have framed out these shorts? Again, we're gonna wait till 8 o'clock. So right at 8 o'clock, what do we wanna do here? With the understanding that we have a failure swing high that was formed right here, I can now drop down into my lower time frame. And I wanna simply wait for price to trade back up into that failure swing high. Once I see that price is taking out internal range liquidity right here, that is when I'm gonna start looking for entries. Again, I can mark out my range from the high down to this swing low right here. We are right above the 50%. Maybe we can push a bit deeper into the premium, maybe above this high. Again, I don't know yet, we're gonna wait and see. But what do we have here? We have this order block that is resting right here. We have this order block resting right here that we can trade up into. And then we have this external range liquidity that I want to see taken out because again, we had a failure swing high above here. This high stayed intact. This high never took out this high. And whenever we have a failure swing high, I want to see the low that created that high taken out, which is this low right here. This low put in this high, which means that this low should now be our target. So ideally, I want to see price push up and then come down and take out this low. Okay, so I've now dropped into my 1 minute time frame. I want to see if we can push up above this high and then trade up into this 5 minute order block. Okay, boom. We've now taken out that high. Okay, so now that we've taken out that high, I want to start framing out a setup. If I were to enter my trade right here, my stop loss would go above this high. It is above the 50% of this 5 minute fair value gap. And this high here is responsible for rebalancing this imbalance right here. There's no need. There's both buying and selling here. This entire leg is rebalanced. On a higher time frame, this is going to represent a wick. If we go back to the 5 minute chart, you're going to see it is a wick. If you go to the 15 minute chart, it is a large wick. So there's no need for price to go any deeper than that. So I could either enter directly as price is taking out that high, or I can wait a little bit. So just because I don't want to frame out the best possible case scenario, I will be entering right here, and my stop loss will be going above this high. With one contract, I am now risking $440, which is again, still less than my 50 tick maximum that I like to have. And I'm going to be targeting this low right here and potentially even this low right here. We also have a new day opening gap that is residing down here that I definitely want to get filled. Okay, so let's go ahead and play out this trade and see what happens here. Drawdown is fine. If you're in drawdown, that's totally fine. As long as your stop loss doesn't get hit, you're all good. Okay, boom. We have that displacement right here. Now, the safer thing to do would be to wait until we have a change in the state of delivery, which would have been right here, which would have kept the entry the exact same. But I entered directly off of the sweep because my stop loss was so tight. I didn't mind if I suffered a little bit of drawdown. Boom. Ultimately, our trade gets played out right here, fills up the entire gap. You'd be up right now $3,000 off of a $400 risk. And then as we have new structural highs created, as we are creating lower highs and lower lows, you can then trail. So you would trail here, then you would trail here once price breaks through this low, and then maybe you could trail here once we officially go through. And then once we create this large displacement leg, then you can now trail here. Then price just ultimately dumps on this given day. Now, if you look at the overall range that we identified earlier, right here, you can actually hold all the way down to that 50% because we are expecting price to come all the way down into that 50% of the buy side of the curve. So this is a specific day where you might have been able to capitalize because the range was so large. You could have held all the way to the 50% or even potentially all the way down into the discount, given the fact that we are expecting price to come all the way down. This whole entire leg right here represents maybe like a 15-minute order block. So you could have theoretically held it all the way down if you wanted to But again, that's all up to your own discretion. For me personally, I would have been out right around the 50% and I would have been content with my profits and I would have been good to go. Now, let's just say that you didn't take the short and you were only looking for longs. How could you have framed a setup here? With the same idea in mind, using the same exact dealing range that we've outlined, you can actually frame out a buy. We have this order block that's resting right here in the discount of that range that we've identified on the 15-minute time frame. Once price trades into that order block, you want to see some sort of rejection out of it, and you want to see the body of that candle that traded within that order block to close above the 50%. If it closes beneath the 50%, in my head, that raises a red flag. I don't want to see that happen. Okay, I want to see price close above the 50% of that order block because that gives me confidence that we are actually going to come back up and take out those highs. Now, because we have so many wicks here, I wouldn't be targeting these overall highs during Asia session. At the bare minimum, though, I do want to see this high taken because this is the high that is responsible for putting in this low. So once price trades into that 15-minute order block, I'm now dropping down into my lower time frame. It's always important to stick to the higher time frame until price reaches your areas of interest, and then you drop down into your lower time frame. Too many times I see traders, they drop down into the lower time frame too early, they get caught up in the chop, and then they blow their accounts or they lose unnecessary money. Okay, so now that we've traded into that 15-minute order block, I have now dropped down into the 1 minute, and I want to start framing out setups. What I want to essentially do right now is wait for there to be a change in the state of delivery. I want to see a displacement candle to the upside close above the opening price of a down close candle. Now that we have our first change in the state of delivery, that is when I will now consider taking an entry. Now, you could have entered right as we were within that order block. However, I find it extremely risky to do so. Also, the stop loss would have been very, very large. It would have been about 100 ticks. If your stop loss is a bit larger, you can size down. But again, I like to trade with one contract and I don't like to go down to micros. So I like to keep my risk consistent every single time. So I'm going to be waiting for an entry to be provided with a decent amount of risk. Okay, so now that we've finally displaced through these down close candles right here, essentially what I want to do is I want to start looking for an entry. So what I'm going to do is I'm going to take my fib, I'm going to mark it up from this low to this high, and I want to wait for price to come beneath the 50% of that range. Ideally, I want price to trade to the 50% of these two down close candles right here. Okay, so we came into the opening of it. I really don't like, we just came to the 50%. I want us to come a little bit deeper before I consider any entry. Okay, this is wonderful. We traded right there at the opening price of this down close candle, which is great. That is when I would consider getting into my trade, and I would have my stop loss down here. Now, this is a bit large of a stop loss. I'm not gonna lie, it is quite large compared to what I prefer it to be. It is 109 ticks. Now, given the fact that the risk to reward is so large, I would be willing to downsize or even risk a little bit more, but this is a trade that I would potentially be taking. So let's just say I got in here, theoretically, my stop loss would go right here. Now, I could put my stop loss at the 50%, but that isn't safe, so I'm just gonna keep it all the way down here with the intention that if we're actually going to push up higher, we're not gonna violate that low. Okay. We now displace upwards. That is great. I will now be putting my stop loss at break even or slightly above it. And I want to see price push up at the bare minimum all the way back up here. Now we might get some sort of rejection right here, which is normal, which is fine. But I really, really want to see price push all the way up. And because I was risking $1,000, I at least want to make a 3 risk to reward. Typically about a 3R is what I'm targeting at the bare minimum, but we could potentially shoot for more if it's given to us. I don't usually have hard TP set. I usually just monitor and trail as price is playing out. So let's kind of see what happens here. Okay, so now that we've put in a little bit more structure, I'm now gonna trail my stop loss and secure some profits. So I really don't wanna see this low taken. It is a protected low because we swept liquidity right here and then it did take out this high and close above it. So I've essentially secured my 3R. Anything that happens past that 3R is additional profits, but I'm content already. I've already essentially secured and I'm good. Okay, boom. Price is starting to push up even more. Once we take out this high, I will trail beneath this low. Okay, now that we've essentially pushed far beyond that high, I would be trailing my stop loss right here. And now I've secured about a 5R, and then my overall TP is gonna go at this high right here, simply because we have this area right here that we could potentially reject off of, which I'm not willing to sit through that chop and hold during London session. At this point right here, oh, boom. I would have probably trailed right here, but you can see my take profit actually just got hit and I would be good to go. Now that I've covered essentially everything going over how to trade Asia on gold, I'm going to put a simple checklist together, almost like a trading plan that you can use and you can follow to apply into your own trading. Okay, so you want to trade between 8 o'clock p.m. and 12 o'clock a.m. Number one, you need to wait for a sweep of internal range liquidity. Always wait for a sweep of internal range liquidity, or maybe even external. Either way, there needs to be liquidity that has been swept. Number two, you can either enter directly off of the sweep, which is sometimes going to have you a larger stop loss and you might suffer a little bit of drawdown, or you can wait for that change in the state of delivery. In that example on the sells, I gave you both examples. I showed you that if we entered off of the change in state delivery, it was an extra confirmation, but I entered directly off of the sweep. Either one works. It just depends with which one you're more comfortable with. Next, you want to target at the bare minimum the 50% of the opposing range. If you do want to hold a little bit longer, you can trail according to each, higher highs and higher lows that get created, or lower highs and lower lows that get created, depending on if you're buying or selling. And then 50 ticks and less is ideal for your stop loss. However, if you do see an opportunity that presents itself and it's just too good to pass on, and it is larger than 50 ticks, adjust your trading size accordingly, adjust the amount of contracts that you're trading. Maybe you have to go down to micros, or just accept the overall risk that comes with it. Again, that is entirely up to you. And then another thing as well, if you take 2 losses in a row during Asia, just simply walk away. There's no point in blowing your account during Asia. Typically if I even take 1 loss, I'll just walk away and I'll just call it for Asia session, and then I'll come back for the next day. That is literally my Asia session gold strategy. No indicators, no guessing, just clean liquidity and structure. If you're new to trading, this is the best way to learn how to respect time and price while also building discipline and consistency. Before I end this video, I do want to make it very clear that if you're interested in becoming a student of mine, you want to become a one-on-one student and learn how you can start leveraging copy trading to make your first $10, $12, $15, $20,000 a month, a link to apply is going to be down in the description below. As a side note, there is going to be a 4-figure investment to become a student of mine, and I am going to be hand selecting a limited amount of individuals to work with me one-on-one. I do not accept everybody. Whoever applies down below, I'll see if you qualify, and then I'll reach out. If you like the video, go ahead and leave a comment, like, and subscribe, and I'll see you guys in the next one. Peace.